Marcus retired at 62 after spending more than 30 years doing everything the right way financially. He saved consistently, avoided unnecessary debt, and built a sizable traditional IRA worth nearly $600,000. By the time retirement arrived, he had a detailed plan already mapped out. The strategy seemed smart. During the first few years of retirement, before Social Security and required minimum distributions kicked in, his taxable income would be unusually low. That created what many advisors call a golden tax window. So Marcus decided to move money from his traditional IRA into a Roth IRA gradually. Pay taxes now while rates were favorable. Allow the money to grow tax-free forever afterward. No future taxes. No required minimum distributions on the Roth. He had researched the strategy carefully. Read books, watched videos, spoke with professionals. Everything told him he was making a smart long-term decision. Over a 2-year period, he converted roughly $180,000 into his Roth IRA. He even paid the taxes separately from his savings account, so the full converted balance stayed invested inside the Roth. His financial advisor congratulated him, said he was executing the strategy perfectly. Then Marcus turned 65. He enrolled in Medicare, and shortly afterward, a letter arrived from the Social Security Administration. Instead of paying the standard Medicare Part B premium of around $185 per month, like most retirees, Marcus was told he and his wife would each owe $443.90 every month. That meant their household Medicare costs were thousands of dollars higher per year than another retired couple with nearly identical current income. And here's the part that shocked him. The income triggering the increase wasn't from a job. He hadn't worked in years. It came from the Roth conversions he completed back at age 63. Income he had already paid taxes on. Income he assumed was finished and behind him. He made the correct financial move at exactly the wrong age. And right now, this same situation is happening to retirees everywhere. People are following perfectly reasonable retirement strategies, but because they don't understand the timing rules tied to Medicare, they unknowingly trigger thousands of dollars in extra costs before they ever see the warning signs. This video is for educational purposes only and should not be considered financial or tax advice. Always consult a qualified professional regarding your own situation. I'm David. Every week, I break down retirement tax rules, hidden financial traps, and planning strategies most people never hear explained clearly. If you want practical retirement guidance without the confusing jargon, subscribe and turn on notifications now. Today, we're going to unpack exactly why age 63 is one of the most financially important years in retirement planning. I'll explain the Medicare 2-year look-back rule that catches so many retirees off guard. I'll show you exactly how the IRMAA system works using confirmed 2026 numbers, and I'll walk you through what actions make sense depending on whether you're 60, 61, 62, 63, already on Medicare, or somewhere in between. Because this isn't some obscure technicality. Real retirees are getting hit with these costs right now simply because nobody explained how dramatically the rules change once you reach 63. What most people don't understand about Medicare premiums. Most retirees know Medicare Part B comes with a monthly premium. What many people don't realize is that Medicare premiums are income-based, and even more importantly, the income Medicare uses is not your income today. It's your income from 2 years earlier. For 2026, the standard Medicare Part B premium is $185 per month per person. That's the base amount. If your modified adjusted gross income from 2024 was below $106,000 for single filers or $212,000 for married couples filing jointly, you pay that standard premium. But once your income crosses those limits, Medicare applies something called IRMAA. IRMAA stands for Income-Related Monthly Adjustment Amount, and this is where things become expensive very quickly. Because IRMAA doesn't increase gradually like tax brackets do, it works more like a cliff. Go over the threshold by even $1, and your entire Medicare premium jumps into the next pricing tier immediately. For married couples, crossing into the first IRMAA tier can mean paying nearly $2,000 more annually in Medicare premiums, not because of what's happening financially right now, but because of income reported on a tax return filed 2 years earlier. Let's make this concrete using the actual 2026 numbers. If your income falls below $106,000 single or $212,000 married filing jointly, your Part B premium stays at the standard $185 monthly amount. Move into the first IRMAA tier, between $106,000 and $133,000 single or $212,000 to $266,000 joint, and your premium jumps to roughly $259 monthly per person. The second tier raises that amount to approximately $370 monthly. The third tier climbs to $480.90. The fourth reaches $591.90, and the highest tier exceeds $623 per person every month. For married retirees at the top tier, Medicare Part B alone can cost over $15,000 annually. Meanwhile, another couple receiving identical Medicare coverage may pay less than 1/3 of that amount. Same health care, completely different cost, and the entire difference traces back to income from 2 years earlier. That's what makes IRMAA so dangerous. One extra dollar can push you into a completely new pricing category, and once you cross that line, the higher premium applies for the entire year. You can't argue that the income was temporary. You can't explain that it came from a one-time financial event. You can't tell Medicare you already paid taxes on it. The system simply looks at your tax return from 2 years ago and calculates the premium accordingly. Why age 63 changes everything. Most people begin Medicare at age 65, and when you first enroll, Medicare uses the tax return from 2 years prior to determine your premium. That means your Medicare cost at age 65 is based on the income you reported when you were 63. Not 64, not 65, age 63. That's why this year becomes so important. If you're 63 right now, every major income decision you make before December 31st directly affects what you'll pay for Medicare 2 years from now. The Roth conversion, the large IRA withdrawal, the stock sale, capital gains, rental income, business income, all of it lands on the tax return Medicare will eventually use. If you're 62, your income still matters, but your age 63 tax year becomes the first one tied directly to your Medicare enrollment. In many ways, age 62 is your final, safe planning year before Medicare starts paying attention. If you're 61, you still have more flexibility. You have time to structure Roth conversions and income planning before the IRMAA clock begins affecting your future premiums. But if you're already 63 and haven't thought about any of this before now, the financial choices you make this year may become some of the most expensive retirement decisions you'll ever make. The critical piece. Most advisors never explain. Here's the uncomfortable truth. A lot of retirement planning advice is technically correct, but incomplete. Financial advisors constantly recommend Roth conversions during low-income retirement years, and generally speaking, that strategy makes sense, but many advisors never connect those recommendations to the timing of Medicare enrollment. Nobody stops to explain that low income at age 63 still carries consequences later because of IRMAA. You can owe very little federal income tax on a Roth conversion and still trigger thousands of dollars in future Medicare premium increases. Why? Because the IRS tax system and the Medicare IRMAA system are completely separate calculations. That distinction matters enormously. A Roth conversion may make perfect tax sense while simultaneously causing expensive Medicare consequences. And most retirees never realize the two systems are operating independently until the premium notice arrives. 3 real-life examples. Let's walk through a few scenarios so you can see exactly how this plays out. Scenario 1. David is 63 and retired 2 years ago after decades working in manufacturing. He has roughly $420,000 inside a traditional IRA and receives a modest pension that covers most of his living expenses. His taxable income is relatively low, so he decides this is the perfect time to start Roth conversions. This year, David converts $120,000. Once everything is added together, his modified adjusted gross income reaches $139,000. That pushes him beyond the first IRMAA threshold for single filers. 2 years later, when David enrolls in Medicare, his premium isn't the standard amount anymore. Instead of paying $185 monthly, he owes roughly $370 every month. That's an additional $2,220 annually for identical Medicare coverage. Across 2 years of IRMAA charges, David ends up paying around $4,400 more than necessary. Now here's the frustrating part. The Roth conversion itself may still have been a smart, long-term move, but had he completed the same conversion at age 61 instead of 63, or spread it over multiple years to remain below the threshold, those Medicare penalties likely never would have happened. Same strategy, different timing, thousands saved. Scenario 2. Sandra and Thomas. Sandra and Thomas are both 63. Sandra earns about $48,000 doing part-time consulting work. Thomas receives Social Security benefits. During the same year, they also sell appreciated stock Sandra inherited from her father decades earlier, generating around $60,000 in gains. Add everything together, consulting income, Social Security, stock gains, and a modest IRA withdrawal, and their total MAG reaches roughly $245,000. At the time, none of this seemed unusual. They weren't making reckless financial decisions. They were simply managing their retirement finances. Nobody warned them that the stock sale at age 63 would affect Medicare premiums at 65. Nobody explained that even a relatively small IRA withdrawal contributed to the problem. 2 years later, they enroll in Medicare. Their premiums jump into a higher IRMAA tier. Together, they pay thousands more annually for Medicare coverage than they otherwise would have. Over the course of 2 years, the added cost approaches $9,000, and much of it could have been avoided simply by spreading the stock sale across multiple tax years or using different assets for cash needs. No complicated strategy required, just awareness beforehand. Scenario 3. Margaret is also 63. She's a retired nurse receiving a pension and Social Security totaling around $64,000 annually. She doesn't have large IRA balances, no Roth conversions, no major investment sales. She's never even heard of IRMAA. When she enrolls in Medicare at 65, she pays the standard premium because her income never crossed the thresholds. And honestly, Margaret represents many retirees. For people living primarily on Social Security and moderate retirement income, age 63 may not create major IRMAA issues at all. But if you have sizable retirement accounts, appreciated investments, rental properties, stock options, or significant taxable income flexibility, you are not Margaret. You are far closer to David and Sandra. And that means age 63 matters tremendously. The 3 financial systems colliding at age 63. What makes this age especially complicated is that 3 entirely separate systems suddenly begin interacting with one another, and each system wants something different from your income. System number 1, income taxes. For many retirees, the early 60s create unusually low taxable income years. No required minimum distributions yet, possibly delaying Social Security. Employment income gone. That creates an ideal environment for Roth conversions. From a tax perspective, generating extra income now can make excellent sense. System number 2, ACA health insurance subsidies. If you retired before Medicare eligibility and buy insurance through the Affordable Care Act marketplace, your subsidy depends heavily on income. Keep income lower, and health insurance subsidies remain larger. Raise income too much, and those subsidies shrink or disappear entirely. System number 3, IRMAA. Now Medicare enters the picture. At 63, your income begins determining future Medicare premiums. So now you have 3 systems all competing against one another. Taxes say, Generate income now while tax brackets are low. A CA subsidies say, keep income low to preserve healthcare assistance. IRMAA says, keep income below Medicare thresholds to avoid future premium surcharges. And there is no universal answer that perfectly solves all three simultaneously. Every retiree's situation is different. The timeline. Most people never see clearly. Your Medicare premium in 2026 is based on your 2024 tax return. Your 2027 premium uses your 2025 return. Your 2028 premium uses 2026 income. The cycle never stops. That's why this isn't only an age 63 issue forever. The IRMAA look-back follows retirees throughout retirement. At 73, required minimum distributions may suddenly push someone into higher premium brackets. At 75, a large capital gain can still create higher Medicare costs 2 years later, but age 63 is where the process begins. It's the first year most retirees unknowingly step into Medicare's income monitoring system. And that's why Roth conversions completed earlier, around ages 60 or 61, are often far more valuable from a Medicare planning perspective. By the time Medicare begins using your tax returns, those earlier conversions are already outside the look-back window. Can you appeal IRMAA? Yes, but only under specific conditions. The Social Security Administration allows appeals using Form SSA 44 for certain life-changing events. These include retirement, loss of income, death of a spouse, divorce, loss of pension income, or similar major financial disruptions. If your income dropped dramatically because of one of these qualifying events, Medicare may agree to use a more recent tax year instead. But here's what does not qualify: voluntary Roth conversions. If you intentionally created higher income through a conversion strategy, Medicare generally treats that as a planned financial decision, not a hardship. So while IRMAA may eventually disappear naturally as the look-back moves forward, the higher premiums during those years are still very real. The widow penalty. Nobody talks about. There's another version of this problem that can become especially painful, and almost nobody discusses it in advance. When one spouse dies, the surviving spouse usually shifts from married filing jointly to single filing status. That change cuts the IRMAA thresholds dramatically. A married couple living comfortably below the joint thresholds can suddenly find the surviving spouse pushed into much higher IRMAA brackets, despite having essentially the same income. That's what's often called the widow penalty. Imagine a couple earning $200,000 jointly. As married filers, they may remain below the first IRMAA threshold. But after one spouse passes away, the surviving spouse files as single. Now that same income may place them several tiers higher. Their Medicare premium can jump from roughly $185 monthly to nearly $481 monthly without any increase in actual income. The filing status changed. That's all. And this is another major reason why Roth conversions earlier in retirement can become so valuable. Tax-free Roth withdrawals later in life help surviving spouses keep taxable income lower after filing status changes. Your action plan by age. If you're 60 or 61, you still have maximum flexibility. These may be your best Roth conversion years before Medicare begins tracking income for IRMAA purposes. Use this window carefully and intentionally. If you're 62, begin planning aggressively. You're approaching the years that directly impact Medicare premiums. Run detailed income projections before large conversions or investment sales. If you're 63, pause before making any major income decision. Review your projected modified adjusted gross income carefully. Know exactly where the IRMAA thresholds sit for your filing status. Do not guess. One poorly timed decision can create thousands in additional costs 2 years later. If you're 64, the same planning still matters because your second year of Medicare depends on this year's income. And if you're already on Medicare, review whether you qualify for an SSA 44 appeal after retirement or another qualifying life event. Also consider qualified charitable distributions if you're over the eligible age. QCDs allow retirees to donate directly from IRAs to charity while excluding those amounts from taxable income. That can help reduce MAGI and potentially avoid crossing IRMAA thresholds. Why this keeps happening? None of these rules are secret. Medicare publishes them, Social Security explains them, financial publications discuss them. The real problem is that almost nobody connects the timing clearly enough for retirees to understand the consequences before it's too late. People hear Roth conversions are smart, convert during low-income years, take advantage of low tax brackets, and all of that may be true. But without understanding how age 63 interacts with Medicare's two-year look-back system, retirees end up walking directly into costs they never expected. The strategy itself may have been correct, the timing awareness was missing, and in retirement planning, timing changes everything. The people who navigate retirement most successfully aren't always the wealthiest or smartest. They're the people who understand that different ages come with different financial rules. Age 61 and 62 are often your most flexible planning years. Age 63 is when Medicare begins watching. Age 64 continues the look back. Age 65 is when the bill finally arrives. One retiree paid nearly $5,000 extra in Medicare premiums simply because a Roth conversion happened at 63 instead of earlier. 2 years later, after the look-back shifted to lower income tax returns, the premiums dropped again. The penalty wasn't permanent, but it was absolutely real, and it was almost entirely avoidable. If this video helped you understand something you hadn't seen clearly before, hit the like button and share it with anyone approaching retirement who still has money sitting in traditional retirement accounts. Because the earlier people understand these rules, the more options they still have. And once age 63 arrives, the clock is already running.